Okay, thank you, Rennie, and welcome everyone today to the Blockchain Investment Trends in Review webinar. Thank you, Robert, for coming in and joining us today. It's a pleasure to have you.
Thanks for having me here.
Yeah, it should be a fun time. So just a quick overview of what we'll be discussing today. First, we'll have a brief conversation about what blockchain is. We'll then move on to blockchain venture and equity investments and look at how that landscape has shifted over time. We'll turn to the elephant in the room and the hottest topic of the day, initial coin offerings and tokens. After that, we'll take a brief look at blockchain corporate investment and how that has changed since the technology's earliest days. And at the end, we'll sum up with some key takeaways and open the floor for Q&A. Just as a note here, after each section, we will have a short Q&A on the information presented in that section. So first, let's start off with a 3-minute primer on what blockchain is. So I'll actually ask you, Robert, in your own words, could you answer the million-dollar question, what is blockchain?
I'll attempt a definition. Although blockchain means a lot of things to a lot of different people. But what it's kind of come to describe is this whole sector of technology that includes modernized tamper-resistant databases. And by modernized, I basically mean that it's networked, so you have multiple stakeholders that don't have to rely on a centralized authority to tell you what's true and accurate. And it is verifiable and auditable.
Cool. And why is that important?
Yeah, so good question. The way I described it so I wrote a recent story for Fortune about blockchain and why businesses are really interested in this thing. And I compare it to the development of double-entry bookkeeping in Renaissance Italy. If you're familiar with the history of accounting, this basically allowed capitalism to thrive because people had record books that they could maintain that were not susceptible to fraud. This is basically that, except it's triple entry bookkeeping, where the third entry is a sort of verifiable cryptographic receipt, which sounds kind of like nonsense, but basically it allows you to determine the authenticity of anything that winds up on that ledger.
Right, so that, according to that definition, there are broad implications for corporates and for basically every sector out there. Can you describe some of the immediate use cases that you see for blockchain?
Sure. I mean, one of the most obvious and applicable use cases is in finance. Everybody's probably familiar with Bitcoin, and the whole value proposition of this technology is that you don't need a bank to authorize any transactions or ensure that you have the money you say you do and to make a payment to somebody. Instead, you can do it all by yourselves as long as you have a cryptographic private key.
Very cool. Okay, so with that in mind, I think we'll dive in. Let's first start off looking at blockchain venture and equity investment. So since 2012, we've seen over 650 equity deals specifically closing for over $2 billion. And within this, we've seen a couple of key themes. First, we've seen VC investments really shift over time. So, as you were describing, Robert, blockchain's earliest use case, or I guess the moment that spawned it all was the creation of Bitcoin. So VCs really early on explored blockchain's use case as a currency, as a way to pay without a central intermediary. That shifted in about 2014, 2015 to expanding blockchain beyond Bitcoin and looking at use cases in other sectors. And now today we're seeing signs of maturation, at least in the venture and equity financing side of investment into the sector. So let's dive in. Okay, so again, as we already touched upon for a brief moment, early investments into the sector really focused on cryptocurrency as a means of payment, and also as a way to exchange fiat for cryptocurrencies or to trade. So you can see here, Abra was an early investment and allowed for remittance payments. Coinbase, which is a notable blockchain unicorn, is one of the most prominent exchanges worldwide to buy a couple of cryptocurrencies. However, that use case as a means of exchange really came under fire often. As you see here in this quote from Howard Marks, this year alone, Bitcoin has risen more than 350%, and that number has probably changed over the past couple of weeks. If you have a currency that is so volatile, is that desirable? And we've noticed this shift impact the way that startups are thinking about the space. So with Coinbase at least, its early value proposition was as a way to transact with instant payments, simple transfers, and hopefully with widespread adoption. But over time, that message shifted to one of how to invest and make money off of digital currencies. Again, also, we've seen in the sector a pretty high rate of failure among startups, or a low rate of follow-on equity funding. So when compared to general tech, we compared it to a 2008 through 2010 tech cohort of companies that received a seed or angel round in 2008 through 2010. We found that blockchain has actually a lower rate of follow-on funding than their general tech peers, indicating that it's a pretty risky sector. And in 2015, as a result of poor usage among its earliest use cases as a means of exchange, we saw the conversation shift from Bitcoin to blockchain. So, as this title puts it, Bitcoin bad, blockchain good. And that meant, to a large degree, corporates and other industry players looking at blockchain and Bitcoin and saying, hey, we really like this blockchain stuff and the technology here, but we're not a fan of this crypto anarchist Bitcoin implementation of transferring money without any sort of middlemen. So that really played out in the development of enterprise and general blockchain solutions. GEM is developing blockchain solutions for healthcare. And we also saw that play out more immediately in financial services as a result of Bitcoin's focus on payments and finance. It was a pretty natural progression. And over time, as the sector's matured, we've seen a number of investments into farther-ranging blockchain applications. So just over here, we have some brand-name investors and their equity investments into blockchain companies. So we've seen that span the spectrum. A couple of notable companies here are MediaChain, which was actually acquired by Spotify, and that deals with digital rights management. And another one is OpenBazaar, which deals with commerce and using a blockchain for e-commerce. Today we're seeing something of a actually pretty surprising, a pretty surprising rise in the number of equity deals. We had expected that initial coin offerings, which we'll get to soon, would take the lion's share of deal flow, but actually we're seeing maturation and a rise in equity deals. We're also seeing funding, which should hit its peak along with equity deals this year. In large part, total funding this year has been boosted by mega deals to Coinbase, R3, and Digital Asset, among others. The top investors in the space remain blockchain-focused firms. So Digital Currency Group, Blockchain Capital, Pantera Capital, and Fenbushi Capital are all specifically focused on blockchain investments. The top three here, as you can see highlighted in orange, are blockchain-focused firms. So we're seeing them continue to make the majority of investments into blockchain companies. And just indicating maturation again, if you look at the global deal share by stage, in 2017 year to date, we're seeing fewer equity deals close at seed and Series A, but we're also seeing more equity deals in later stages, or a continuation of that trend from 2016. And lastly, if you look at the geographic distribution of deal share, where you initially saw most deals concentrated in the US or the top 10 countries, we're actually seeing a rise of the rest here as more deal share flows to countries outside the top 10, which is interesting because of the technology's inherently borderless nature. Okay, so we'll actually, just to review some of the key trends that we saw in this section, We've seen VC investment shifting over time. We're seeing record growth in equity deals and equity funding. And we contribute that in large part to just a general interest in the sector as the market cap of cryptocurrencies has risen drastically, and as ICOs have really taken front and center stage, which we'll get into momentarily. So I think we'll open it up for questions. Robert, I guess I'll ask you this first. We've seen the landscape shift. What do you think is next? Where do you think the venture money will go in the future?
Yeah, so I would say in terms of the places where blockchain might have the most potential to disrupt what's going on right now, as I mentioned at the beginning, finance is very obvious. But there are other areas too, like supply chain is ripe for a reckoning, as is the healthcare industry. I mean, medical records and electronic medical records are a total mess. And the more and more I talk to people, I keep hearing about identity. Identity is kind of like the killer app that they want blockchain-based applications to solve in order so that you can build other sorts of nifty applications on top of that.
And that's interesting, right? Because Bitcoin, in a sense, is pseudonymous, right? It's pseudo-anonymous in the sense that everyone has a serial number assigned to them, but we don't necessarily know who that serial number is assigned to. But at the same time, you can track the transaction history of that serial number throughout the blockchain with 100% accuracy. So what does that, I guess, tell you about how important identity is, or how does that play out in your mind?
It's very, very important, especially if you want to satisfy regulators who have know your customer and anti-money laundering laws that you have to obey. That being said, there are some coins out there that are going the other route and touting privacy features that are actually getting at true anonymity. And you've got coins like Zcash or Monero that kind of achieve this through different ways.
And is that scary?
For some people it might be, yeah. It also solves a pretty unique problem of fungibility, which basically means every one of these tokens within this network is exactly like any other token. Whereas if you have a traditional blockchain like Bitcoin, you can see the provenance of that coin. You know where it came from, you know who's sending it to who, and you could potentially censor transactions if you don't like where that money's headed.
Right. Interesting. Let's open the. Let's take some questions here from the audience that came in. We have one question here. Which industry / practice do you think blockchain has the most potential to affect / disrupt? Again, we've spoken a lot about financial services. You mentioned identity. Can you talk a bit more about supply chain?
Yeah, definitely. So there are a lot of corporations that are interested in overhauling their supply chains, one of which is Walmart. I spoke to them quite a bit about this, and they're super excited. They're using Hyperledger Fabric, which was created by IBM and then now is maintained by the Linux Foundation.
And we'll get to that in the corporate section as well. But
sure.
Yeah.
But yeah, I mean, if you look, there's also Dole, Nestle, all these companies. They basically want to make their the record of supplies that move through their chain, auditable. Know where things come from, be able to track it back if there's ever a food outbreak or something like that. Because right now the system's entirely fragmented. And a lot is done by hand on paper and pen, which is not ideal.
Right, definitely. There's another question here about why blockchain companies have seen a lower rate of follow-on funding. Just to speak to that for a moment, the technology is so nascent and so new and comes from such interesting roots, for lack of a better term, that investors, to a large degree, at least initially, in the cohort that we tracked, really didn't know what to make of the tech, really didn't know the capabilities of the tech or what it could do or could imply. And still today, as we're going to get into in a couple of moments with ICOs, most of these companies have not created products. Most of these companies have a lack of users or real transactions on their network. So we are seeing a lower rate of follow-on funding as a result of limited real usage, limited real use cases, but at the same time we're seeing increased funding as the potential has really gained or hit, I don't know its peak, but definitely hit a hype cycle as of late. let's see, what else do we have here? Are digital currencies and VC funds fundamentally at odds? Interesting question. I think we'll get into this in a couple of moments in the next section. Yeah, but I think with that, we'll actually move on to the next section. So looking at the rise of initial coin offerings, in 2017, we really saw the conversation shift from blockchain to crypto. As you can see here are just a couple of headlines kind of highlighting that trend. But within that, we've seen some key themes that we'll get into in this section. One is that initial coin offerings have raised over $2 billion this year alone, at least in completed initial coin offerings. And they're increasing at a faster rate than traditional equity dollars and deals. One question that was asked by the audience, which we'll address here, is the question of VC with initial coin offerings or tokens. And then lastly, we'll address overcapitalization. Are these companies receiving too much money too early, and what does that do or how does that impact incentives? So diving into initial coin offerings, what are they? So at the most basic level, and Robert, I hope you can help me out here as well. The proposal of an initial coin offering is to exchange a token that has utility within the network for cash. So imagine that there were a Facebook that only had 1,000 usernames available or 1,000 tokens available to use that network. If that decentralized Facebook became valuable, those tokens would in turn rise in value. So the process by which a blockchain holds an initial coin offering or an ICO, they typically announce. They hope to embed value in the protocol and reward investors, developers, and users. They exchange the tokens for cash. That cash is typically denominated in Bitcoin or Ether. And then those tokens are subsequently traded on exchanges. One concern that has come up often is whether or not these tokens constitute a securities offering, which would certainly put them on the wrong side of the law. And a common test that is cited is the Howey test, which basically looks at 4 criteria to determine if your offering constitutes a securities offering. Is there an investment of money in a common enterprise with an expectation of profits from the efforts of others? If your token falls into all 4 of those buckets, you're most likely out of luck and you should probably seek legal counsel. Again, so since 2016, we've seen more than 250 ICOs closed for well over $2 billion. The ones that haven't closed have raised, let's say, $500,000 and are still raising money. So we're continuing to see tons of money flow into the sector, tons of liquidity, and tons of capital. Fred Wilson, who is a partner at Union Square Ventures, has been one of the most outspoken proponents of blockchain tech and sees tokens as fundamentally changing the VC business model. And you can kind of see that played out here. Whereas traditional blockchain startups went to VCs for money, we're seeing ICOs increase at a much faster rate than their equity counterparts. And we're also seeing them raise quite a bit more money. As you can see in Q2 17 of this year, that's when total ICO funding for that quarter surpassed equity funding. And this trend looks only to be increasing, at least in the short term. VCs have invested accordingly. They've taken an approach to make sure that they're capitalizing on this recent trend. We're seeing them invest in cryptocurrency hedge funds like Polychain Capital and Metastable, as well as directly in tokens. So Filecoin was a recent token sale, or held a recent token sale, and held a pre-sale for accredited investors to essentially invest in the token and in the network. And ICOs span the spectrum. They're attacking a wide array of verticals, from media to browsers and social networks to financial services. But most of the money raised via ICOs has gone toward projects that look to develop the technology's underlying foundation and ecosystem. These projects include Tezos, which has recently come under fire, EOS, or Filecoin. And at the same time, with this amount of money flowing to initial coin offerings and to blockchain startups, Regulators and pundits, I guess, have been quick to point out how dangerous ICOs can be. There have been numerous scams, and more importantly, overcapitalization, or the idea of getting too much money too quickly, is a continuing concern. You can see a couple of headlines here that allude to this. And again, this idea of token logic, or that this time is different, has generally come to the fore when discussing blockchain technology, or when investors have looked at the tech. As you can see here, ICOs, which for all intents and purposes represent early stage financing, have far surpassed the average for blockchain early stage funding for equity deals. And as a whole, the amount of money raised by ICOs is nearly equivalent in Q3 17, with all money going to tech, seed, and angel deals, which is truly unbelievable to consider. Again, with this much money sloshing around the market, we've seen scammers try to take advantage. Here's a quote from Stephen Piken, who's the co-director of the SEC Division of Enforcement, pointing out all the roaches and the scams that tend to crawl out of the woodwork. On a good note, though, we're starting to see attempts at self-regulation. The SAFT, or the Safe Agreement for Future Tokens, is one such example. And essentially, the contract proposes a forward contract that, at the time of the token sale or the pre-sale, is considered a security, but once the network is functional and operating, converts to a token, and then is no longer considered a security. And if Bitcoin is any indication, we've seen countless obituaries for Bitcoin since its inception, and the network has stayed surprisingly resilient. While we concur that ICOs are certainly frothy, we also see tokens as representing a fundamentally new way to incentivize various stakeholders in an organization, from investors to developers to users, all incentivized to increase the value of the network in question. Okay, so we will open the conversation up again for questions on ICOs. Robert, in your own words, what's next for ICOs? Is the market settling down? Where do you see us going from here?
Well, it seems like the SEC is finally providing some guidance for people to know when they're playing by the right rules, rather than just kind of guessing and hoping that they're within bounds. So it seems like this stuff is actually getting a little bit more regulated and okay to do.
Yeah, for sure. Do you see, we'll take a question from the audience here. What's the impact on VCs? I know we touched on it briefly, but how are venture capitalists approaching this? How are they going to be impacted? One idea that I heard that I thought was quite interesting was that venture capitalists traditionally have a very good idea of when to enter a company, but they don't really focus on how the company exits. In the same way that, let's say, a hedge fund would. A hedge fund is obviously very much focused on when to buy and when to sell, whereas VCs are traditionally focused on when to buy, but not necessarily on when to sell, only that they have to sell. So how do you see that playing out?
Yeah, I mean, this is what makes initial coin offerings so interesting and unique. If you are going to put money into them, you don't necessarily have to wait for that final exit. You don't have to wait for an IPO. You don't have to wait for an acquisition. You can pull your money out whenever you want, as long as this coin is listed on some online exchange. So it's very liquid, and basically people can, do as they will.
Interesting. And last question here, just talking about I guess overcapitalization again. We've seen the whole saga with Tezos play out pretty poorly for their founders. What are your thoughts on how much money these companies are raising, and what do you think is the future of token sales and how they raise money?
Yeah, I mean, what this gets down to is people at this point don't have a great idea about how to value these assets. Right. A lot of this is being done on speculation. People are hoping that they'll buy now and be able to sell some coin for a good return later on. And that is causing these wild numbers that you're seeing, tens of millions of dollars on average for these very, very early stage projects that have basically nothing to their name aside from a white paper document that outlines some ideas.
Right.
Yeah.
Yeah, I couldn't agree more. And I hope, and I think we're starting to see attempts at self-regulation and kind of reining in that, for lack of a better term, the ridiculous valuations that we've seen in the sector. So
definitely,
I'm optimistic about the tech, and I hope that we continue to make sure that we're playing according to the traditional rules. Okay, moving on to our last section before our open Q&A. Let's talk about the role of corporates and corporations in blockchain. So traditionally, first we'll talk about the total numbers. Since 2012, corporates have participated in 140 plus equity deals, closing for over $1.2 billion. A couple of key themes in this section that we'll walk through. Corporate investment generally falls into two categories, private blockchains and consortia. Financial services firms were the first corporates to really get involved in the space. Again, we've talked about how blockchain has really had a financial services bend to it since its inception. And we've seen them remain the most active corporates, or among the most active corporates. At the same time, we're continuing to see a rise in corporate investment, and we're also continuing to see the consortia develop, grow geographically, grow in terms of the number of their members, and prove out their projects. So just as you can see here, we really saw a ton of financial services firms make their first direct investment into the space in late 2015, early 2016. Much of that was for R3 and digital assets. And as corporate investment stands today, we're seeing the highest number of corporate investors make investments in the sector, with that number hitting its peak at 91 already in the sector, already in 2017. And if you look at the number of active VCs in the space, corporates are quickly closing in on that number for this year. We also expect to see the highest total equity deals in dollars with corporate participation this year. And when we look at the most active corporate investors, financial services firms are certainly well represented, but two firms stick out, Google and Overstock. Google has made wide-ranging investments into the tech, while Overstock CEO Patrick Byrne is very bullish on the technology and most recently announced a blockchain-based securities trading platform called T0. The other area of interest for corporates is consortia, which try to bridge the gap to a certain degree between public and private blockchains. Again, the point of a blockchain is to allow for untrusted parties to transact without a middleman. So consortia build on this model and try to allow for minimal centralization in allowing competitive players to operate on the same database. Hyperledger is the first one that we'll speak about. It's one of the most well-known and respected consortia with a strong presence globally and strong corporate backing and support. Their code is open source. It's supported by the Linux Foundation, and IBM has taken a real leadership role. And we see 5 modules here that have been built out and tested. Fabric is starting to roll out more blockchain proofs of concept and pilots. As Robert mentioned, Walmart was a notable example. Most recently, we've seen a project called Quilt, which offers solutions for healthcare providers. Turning to the Enterprise Ethereum Alliance, it stands in contrast to Hyperledger. It's built on Ethereum, and it has a number of the same players as Hyperledger, actually, but it is led by Microsoft, who is absent from Hyperledger, and with support from the Ethereum Foundation and Consensus. The EEA is working broadly to establish business solutions using Ethereum, and a notable implementation of Ethereum is Quorum, which is a private blockchain run by JP Morgan, and they've received support from the EEA. Ripple is one of the earliest consortia, and a bit different from the previous two in that it has a native token called XRP. Ripple allows banks and financial institutions to pay and transfer funds across borders and currencies. More than 75 banks are on Ripple's network, and they have successfully tested domestic money transfers between 47 Japanese banks using blockchain. And they're continuing to add more members this year and hopefully into next year. R3 is one of the earliest financial services blockchain consortia. However, the consortium really pivoted away from blockchain and towards distributed ledger technology, especially with the release of its platform, Corda. So the consortium has also seen a number of high-profile exits, as you can see here, denoted by the red lines. Most recently, JP Morgan Chase left the consortium, and these investors or corporates cited high fees and disagreements over the equity breakdown in R3. And we'll be taking general questions on the role of corporates in the space in just a moment. But just to review the key takeaways from this report and what the road ahead looks like. So again, we've really seen the rise of ICOs, raising more than $2 billion this year alone. We've seen equity deals in dollars rise. We've seen mega deals push that equity funding up, but the rate of growth slowing as ICOs take hold. And we've seen an increase in corporate investment. So I guess if you had to put a term to describe this year, it might be a rising tide lifts all boats. We've really seen the, I guess, press and the value of ICOs and cryptocurrencies spur new conversation around venture investments as well as corporate investments into the space. And in terms of VCs, we're seeing a real shift as ICOs look to remain the financing method of choice for blockchain startups. VCs are starting to grapple with the questions of how to capitalize, how to maintain their ownership and, to a certain degree, control of blockchain startups as cryptocurrency hedge funds pop up and tokens allow for pre-sales with VC investment directly. In terms of the road ahead, venture investors are really still looking for usage. That really is the elephant in the room. We really need to see usage beyond speculation for the sector to mature. We hope to continue to see self-regulation and teams holding ICOs to act responsibly. Without self-regulation, we expect state bodies to step in, and they have in countries like Korea and China. And we also note that corporate investors will really have to take a hard look at their blockchain bets that have been spread across patents, consortia, direct investments. The technology is certainly developing, and there are certainly successful pilots. We expect corporates to really engage with the technology in the coming months and in 2018. Okay, with that, feel free to tweet at myself, Robert, or at CB Insights with the hashtag BlockchainCBI. We'll be opening up the webinar again to a couple of minutes of questions. Okay, so Robert, first question I'll ask you. Regulations. What do you think? Where are we headed? What's next?
As you mentioned, a bunch of countries have sort of hit the pause button or banned ICOs outright as they kind of figure out how to get this stuff in order. We're already seeing in the U.S. market, people are abiding by SEC regulations, and now a lot of ICOs go to accredited investors and not to just any old Joe investor.
That's interesting, right? Because the accredited investor aspect of it raises the question of what's the purpose of these tokens?
Yeah, it kind of waters down the initial grand vision of the ICO as being a democratizing force that anybody can participate in, sort of like a Kickstarter. So yeah, it definitely kind of takes away some of the value there. But on the other hand, you don't want to screw over your average retail investors as well, so you can kind of see where the regulators are coming from.
Right. And on that note, I guess one question that we have here is, do ICOs represent the democratization of venture? Does it enable small investors to make direct investments into startups? And on that note, Robert, I think it's a complicated question because we still exist in a world kind of run by governments with regulations, and as decentralized as these systems may be, the actors involved in developing these networks and building out these platforms are still, I guess, centralized in a certain sense because they are known. They're not anonymous. Bitcoin, if you had to pick one way to kind of spread blockchain to the masses, like a petri dish of I guess the perfect experiment, it would have to be Bitcoin, in the sense that nobody knows who its founder is, nobody knows who created it. So I think that on the one hand, ICOs represent a real innovation in crowdfunding because they incentivize users, developers, and investors to all act and raise the value of their respective tokens. But at the same time, investing has been traditionally a highly regulated industry, and I doubt that will disappear overnight. And I also question whether it would be a very good thing if it did disappear overnight.
Yeah, and if you look at some of the venture capital firms and hedge funds that are participating in ICOs right now, they have a sort of traditional structure where it sort of fits the model of those organizations as you conceive of them now, but they want to go to a place where it is decentralized, where you've got smart contracts kind of running this thing, where they have ICOs themselves and people can bid on the tokens. And some of these firms like Blockchain Capital had an ICO in order to enable their own fundraising. So I think maybe you'll see that kind of trend moving forward, the decentralization of these organizations.
For sure. And in the same breath, though, there's so much development happening on the corporate side of things, or the just the back office enterprise solutions side, where blockchain is this buzzword that's proposed as the elixir to all of your corporate ills.
Oh yes.
So one question that I've been dealing with recently is, when does it actually make sense to incorporate a blockchain, and when would it actually be better just to have what these things called databases that we've used for quite some time? And a helpful guide that I've found actually kind of lays it out in terms of a flow chart. Do you need a database? If the answer is yes, do you need to share that database, or are there multiple writers for that database? If the answer is no, then don't use blockchain. If the answer is yes, can you use a trusted third party? And if the answer there is yes, then again, don't use blockchain. Blockchain is very helpful when it's, let's take Bitcoin as an example. We can't trust the parties involved. We don't know who the parties are involved, and we don't want an intermediary. So in that sense, it seems to make sense. But I guess I'll kind of make this into a question. Where do you see as the most promising applications of blockchain that cannot be solved by a database?
So I'll preface this by saying I caught a tweet yesterday from somebody who made a flowchart that said, "Do you need a blockchain?" And then the next square said no, which I thought was hilarious. But the truth is that blockchains can be really valuable and useful in certain cases. And like you said, when there is a complex network involved of different parties that are transacting. If you look at a supply chain, we mentioned Walmart is very interested in this because their supply chains can be very, very complex. If you're talking about mangoes, which they have tracked in a trial on a blockchain, you've got farmers to deal with, you've got brokers, distributors, processors, retailers, regulators, consumers. Like, there are a lot of people involved in that process. And so the more complexity you have, often that is where you get a lot of value.
Interesting, yeah. And at the same time, though, the question still comes down, though, why couldn't you just use a shared database? But certainly there are advantages to blockchain beyond just being a better database. There's advantages in security, in its decentralization.
Yeah, and these terms are kind of amorphous. Like, we've seen R3, they originally were a blockchain startup, quote unquote, and now they're a distributed ledger technology, DLT startup. But honestly, people still lump it all together under the term blockchain. A shared database and a blockchain there is a Venn diagram overlap between those things.
For sure. And that's why we've also seen companies pivot to distributed ledger technology and move away from blockchain.
Exactly.
Like R3 as an example. One question here, with identification still being a major hurdle to greater adoption of the blockchain technology, what are some of the challenges with digital ledger identification? So again, I think as we touched upon earlier, let's take, again, Bitcoin as an example. Bitcoin is, on the one hand, totally anonymous, and on the other hand, the least anonymous platform that you could possibly have. And there is some concern around that. How do you track such a system? But that also opens the door for governments and governments to come in and say, hey, we actually want to build our own cryptocurrency so we can eliminate cash and actually track all the transactions within our borders, which raises some pretty interesting and thorny, I would say, issues.
Yeah, and to your point, I'd mentioned, the question was about the challenges with digital ledger identification, but I would bring up some of the challenges with identification as it exists today in sort of massive centralized databases. We've seen what happened with Equifax when you have one company that is sort of handling all of the data about people. It becomes a very, very interesting target to certain bad actors. So, I mean, it might be that blockchain solves identification problems.
Yeah, certainly. And at the same time, I'd also mention cash. Cash being the, blockchain or Bitcoin is always lumped into this black market arena, and cash is also often used for black market transactions.
Definitely.
Which certainly raises the question of how to deal with that.
And the criminals are moving away from Bitcoin. They're picking up Monero now.
Yes. There are other ones. Can a non-blockchain based tech startup do an ICO? Are the ICOs tokens, equity, or both? So again, I think it's important to think about when an ICO makes sense. What is a token? A token is really utility within a network. So take Bitcoin or Ethereum. These are not companies. These are networks that have been set in motion. These are protocols in much the same way that TCP/IP is a protocol. It's a way for multiple parties to agree on a certain, I guess, way of acting, right? And those tokens provide utility within that network. They provide a way to incentivize the different parties. So the question is I guess the basis of the question is difficult to answer because it's hard to say whether a company would want that for themselves, would want to be like, have no ownership over the future of that company. But at the same time, we've seen companies such as Kik hold an ICO, but their model as a result has shifted drastically.
Yeah. And some of the companies that we've seen that have had ICOs that are not actually tied to a blockchain, like ReCoin or DRC, the SEC has come after them because there's basically just selling magic fairy dust that people are bidding on.
Right. And that's...
So if you are a non-blockchain startup, you can probably have an ICO, but I don't think that's a good idea.
Right. And we do not recommend investing in magic fairy dust. That's just as a disclaimer. In terms of, we have a question here about blockchain being described as a new internet, a distributed network upon which transactions take place and all data/information is stored across the network. A blockchain database that stored all information would be a very, very bad database. Imagine that, the reason why centralized databases are so effective is because they're centralized. A blockchain stores a copy of the ledger on every single node on the network. So imagine that you had, if you wanted to use Facebook, for instance, then you had to store on your own computer the massive amounts of data that Facebook stores. Because as it stands today, Facebook is centralized, they do that for you. If a blockchain were a new internet in the sense that it were just this massive database, we'd all have to have quite a bit of storage on our devices in order to access that. The beauty of Bitcoin or Ethereum is that the ledger is relatively small. It's only a list of transactions. The total size of the Bitcoin network is, I think, under 200 gigabytes. Which again, for being around for 8 years is relatively small. In terms of the VC trends that we're seeing, I know we mentioned equity trends, we mentioned trends in ICOs. How are we seeing VCs getting involved in token pre-sales and pre-SAFT equity rounds? I think to a large degree the way for a VC to get involved without going through a SAFT or without going through a pre-sale is to invest as an LP or as a GP in a cryptocurrency hedge fund. So we've seen investments into Polychain, into Metastable. There's a report that came out recently that cited over 100 cryptocurrency hedge funds popping up. We've seen VCs use that as a way to access tokens which usually fall out of their investment mandates. Typically they have to make equity investments, and since we don't consider tokens equity, or since their status is still up in the air, it's difficult to make direct investments into tokens. I would also say that this could change over time as tokens become more mainstream, or if they do become more mainstream. We could continue to see VCs invest in pre-sales or as accredited investors in token sales. Let's take one more question here. So let's talk about valuation for 1 second. Is there a way to value tokens? How are people approaching this? We've seen, I've seen personally a couple of different methodologies approaching this topic. Chris Burniske is a popular writer. He's published a book recently. Can you value tokens? Is there a way to do it? How are we supposed to do it?
Yeah. So one person I look at in this space who talks about this is Olaf, who heads Olaf Carlson Wee. He heads Polychain Capital, which is one of the more notable hedge funds out there, and he talks about fundamental analysis, which basically is a way to look at the token and understand the utility that one can derive from its use within a network. Now, again, this stuff is very, very new, and people don't really know how to accurately value them, and as a result, a lot of the valuations are going through the roof. There's a lot of hype, a lot of money sloshing around, but some people would suggest that good places to start are to read the white paper of the ICO in question, look at the community that's forming around it and whatever kind of channel they communicate on, whether it's Slack or something else. And read a ton. Read a lot on, a lot of the community hangs out on Reddit and on Steam, so people are chatting all the time. And it's worth noting that people who are hosting these ICOs are becoming hesitant to call them ICOs. They don't really like that terminology because it kind of gets in the face of regulators. It sounds too similar to an IPO.
Sure. And
if you start seeing terms like investment or return on investment, that's sort of a red flag that this is not going to make regulators happy.
Right.
Then start smacking of a security.
It's unfortunate that they launched with that terminology.
Yeah, definitely. Although it is a catchy word, and it's got mainstream appeal. And I use ICO all the time.
I've heard ICO. I really don't like ICO. No. It's ICO. And last question here that we'll take. What kind of disruption can we expect if emerging technologies such as blockchain, AI, IoT, and the cloud are combined? So that's quite a question. But I would say that, at least in terms of Internet of Things and IoT, blockchain is really a almost perfect supplement or collaborative tool with the Internet of Things. One of the biggest issues with IoT is that centralized databases don't really work with Internet of Things. We need the things that are connected, the devices that are connected, to kind of have the ability to think by themselves, but also be connected to a larger network. So blockchain is actually a very good application of that. I do think that as a result, we could see near perfect supply chains, the ability for sensors to track in real time supply chains, those sensors to be connected on a blockchain, and for machines to communicate between themselves in ways that were not possible before. There's the idea of the machine payable network, that has been proposed by Balaji out of 21, which is a popular blockchain company. And that essentially is the idea that if there were a secure way for machines to transact with one another, we could see things like micropayments and other really good use cases for blockchain. With that, I think we're going to sign off and hand the microphone back to Rennie. Oh, actually, we're just going to sign off. Thank you so much for listening. Robert, it's been a pleasure having you today. This is fascinating stuff, and I hope to explore this further with you in the future.
I love to talk about it, so thanks for having me here. And anybody who wants to continue the conversation, follow us on Twitter and let's chat.
Let's chat. Join our Slack groups, and we are happy to talk further about this. So thank you again, and that's all for us today.